Welcome back. Chatting to Geoff Miller, who's the president of TransUnion Africa. And we're looking at the state of credit in the country and how healthy or unhealthy we are. And it doesn't seem that we are very healthy at all, to be honest. We've been talking about how the consumer comes into this, and it's this instant gratification story over and over again. But it's Geoff, I'm sure you'll agree with me, it's not only the consumer, it's also the lender as well. I mean, I know our banks have been very careful about lending. Some people would say overcautious about lending. But there are elements within the retail sector who are lending huge amounts of money.
Yeah, I think there's been a significant rise in unsecured lending, and I think there's been a couple of factors that's driving that. I think one, unsecured lending is attractive to financial institutions, and there's a couple reasons. One, because the interest rate that they're able to charge on an unsecured loan is much higher than on a vehicle asset finance loan or on a mortgage bond. Yeah. So it's more profitable than, to be frank. I think secondly, as you look at Basel III and those requirements coming in over the next couple of years, the capital requirements and the reserve requirements actually make unsecured lending more attractive because it's shorter term and the reserves that they need to place against those loans are lower than perhaps a mortgage bond. So, in some ways the system has incented financial institutions.
That doesn't make sense to me, because surely if you've got a mortgage loan, you have an asset on your books that you can take back if there's a default. But with an unsecured loan, surely your unsecured loans should actually be geared higher in your reserve that you have to have in place.
Well, so it's true, but the way that it's looked at, so one, the unsecured loans, although they're more risky, are priced obviously much higher. So the price of the risk is built into the loan. Secondly, the provisions that banks make on those loans are much higher, so they are anticipating much higher debt. But really, it's the fact that these loans only remain on their books for a couple of years and then fall off, whereas a mortgage bond is 20, 30 years. So
well, you hope they fall off the books, an unsecured loan.
Yeah, well, they work themselves out, exactly. So banks have been incented to do so. And the other thing is, I think it's a matter of convenience, right? So getting an unsecured loan from a consumer's perspective is actually much easier. You walk in with your ID book, you're able to walk out with a loan, versus going through a vehicle asset finance loan process or a mortgage bond process for perhaps a small value, very difficult. And so consumers, once again going back to consumers' education, feel that an easier process is best for them, even though it may cost them more in the longer term.
So even though I could loan over a short term of 6 months, because I need to, against my mortgage that exists on my house, I go off and get an unsecured loan and I'm paying 3% more or 4% more.
Double, triple, probably more.
Oh, really?
In terms of that, So that's kind of been the challenges. So, consumers, and the other thing I think is, consumers have typically been used to short-term credit. So you've looked at 30-day loans, 90-day loans, 120-day loans. And what you see is some of those products out there are now 3-year loans, 4-year loans, 5-year loans. And so you have a consumer that was managing their budget for a short period of time around that repayment. And now they're looking at or have taken out a loan that's over a number of years. And their ability to manage their finances, I think in some cases, is under stress.
Let's before we get onto government's involvement here, because there is a government involvement that's coming into play. Let's just go back to the consumer and managing their credit. You say most people aren't aware of how to do it, but and the education is necessary and all the rest of it. But what should you be doing in the short term right now? Straight after this show, what should you go and do?
So, very easy thing, right?
Thank goodness you said that. Jeez.
Write down on a piece of paper, what your household income is, what you make, what your husband, wife makes, what other support structures you have, and then write out your existing debt, right? So, what do you owe to financial institutions? What do you owe on your retail card? What are you paying on a monthly basis for food? What are you paying on a monthly basis for petrol? For all those different things. And actually just give yourself a quick picture. It doesn't have to be exact, but give yourself a quick picture on what am I bringing in every month, and then what do I have to pay out every month? And if I'm very close to even, that means I probably want to try to be a little bit more reserved around my spending, right? I want to cut corners where I can to kind of give myself some of that leeway, because we all know petrol prices are going to be going up next month with the falling of the rand. So, what your price is or what you're paying today to live is different than what you're paying next month. And, if that's negative or break even, you're really putting yourself in a very precarious position.
I suppose a lot of people don't understand what the price of inflation is costing them, especially if you look at the lower end of the market and you look at the food inflation that's come in there, and people aren't taking that into account. So you're earning X at the beginning of the year. By the end of the year, you're still earning X, but everything has gone
up
exponential. I thought that was quite clever, actually, and he didn't even laugh at that. You're earning X and then it's exponential, I mean. Anyway, sometimes I find myself funny and nobody else does, especially my wife. Let's go back to government now. Give us some detail around this credit, what do they call
Amnesty.
it? Amnesty, yeah. How the heck do you put together a credit amnesty?
Yeah, so the government asked the DTI and the NCR to look into a number of things, affordability. There was an amnesty that actually occurred in 2007.
Damn, I missed it.
that was kind of brought in with the National Credit Act. And so, some of the government institutions went and did some analysis. And they came back with a recommendation that, one, that they need to change affordability guidelines and make some changes to the NCA. And I think we support that. I think more clarity, and the NCA wasn't perfect, so we can fix some of those things that was wrong with it. And then they suggested that a credit amnesty be provided to kind of right the wrongs, and they said the previous amnesty didn't work. So a couple concerns or questions we have about that is, well, if the last amnesty didn't work, why would what's going to be the difference? Why would this amnesty work? I think the second concern we have is, if you look at the details of the amnesty, it's not absolving consumers of their debt. It's wiping out some negative information on their repayment behavior that resides at the credit bureau. So if they owe 100 Rand today, after the amnesty, they still owe that 100 Rand. But what they've done is they've actually asked the credit bureaus or requiring the credit bureaus to remove some of that information. So in instances where we're removing information but the debt is still there, the concern could be, are you now providing a consumer that's already underwater the opportunity to go back and try and get more credit?
Which is what it seems to me to be. Because if I know that my record has been expunged and I can now go back to my bank and say, or another bank, and say, I need a loan of X, and they contact you guys, and you guys say, there's nothing there. They're likely to give it to me.
Yeah, and so it's not all the information they're asking to remove, is about debts that are unpaid, but a portion of it is. And so our concern certainly resides around that. And I also think, there may be unintended consequences of that. So as in the situation you just gave, the financial institutions obviously know that an amnesty has been granted. So after the amnesty, when they look at consumers, they may take actually a much more conservative view. And so consumers that perhaps could have gotten credit prior to the amnesty may not, simply because credit grantors have pulled back. So there may be unintended consequences. So, I think we agree that the reasons or what the government is trying to do is good. It's just, how do we implement that in a way that's responsible?
But surely it should be an amnesty that's granted if, let's say, for example, that 5 years ago, I had I was impaired. Right, is that the right word? Yeah.
Sure.
I was in the poo. Okay. That's how I say it. So I was impaired 5 years ago, but I have been, for want of a better word, rehabilitated. I'm now over that, and I'm earning, and I'm in the clear. Surely it should be those people who the amnesty is given to because they're in the clear, as opposed to me sitting here today and I still owe you R100.
Yep. So, and once again, the amnesty does accomplish that in a portion of it, and in another portion it doesn't. So there is some pre-existing or older judgments and defaults that would be removed under their amnesty proposal. So that there would be some benefit in that. But there are some more current events that consumer still does owe, and that would be wiped out as well. So, once again, I think there's some beneficial provisions and there's some that aren't. But also remember that lenders already build that into their risk criteria, right? So if you were delinquent 2 years ago, when they look at you today, they look at you much differently than if you were delinquent last month. So they already have risk policies that say the longer ago you were delinquent, the less I'm going to rely on that negative information when I look at you. It's really looking at more recent information, and if recently you've been performing very well, they're more likely to lend you money. Whereas if you were 60 days delinquent last month, obviously you can't meet your current financial obligations, so why would they want to extend additional credit to you today?
We're fast running out of time. What should people be looking for? I'm talking from a consumer point of view here. When they're going into a situation where they need to access credit, what are the questions you should be asking to the person who's saying to you, yes, I'll give you credit?
Yeah. So I guess one, most importantly, can you afford it? Right. So do you have that room in your family budget?
So you've done the budget already. You've done I bring in this and it costs me that, and I do have an extra R100.
Correct.
So I want that flat screen.
Exactly.
Okay. Right.
So one, and then secondly, I think is understanding what the credit costs you, and there are mandatory disclosures that talk about the interest rate and what interest you'll be paying on that. So I think you as a consumer have a choice whether or not you want to take that credit. You just need to make sure you understand what the true cost of that credit is. And then you have the ability to perhaps, although you're taking it over an extended period of time or you're putting it on your credit card, if you understand how much that credit costs, you may want to pay that loan back much more quickly if you have a room in your budget. So I think it's secondly understanding what the credit costs. And then I think thirdly, as any good consumer should do, is shop around and make sure that you're getting the best deal from the financial institution.
So I could turn around and say to the person who's selling me this, if I paid you cash today, how much would it cost me? And if I take it on the credit plan that you're suggesting, how much will it cost me at the end of that plan?
Correct.
You can turn around and demand those answers.
Yeah, there's some mandatory disclosures around what the total payments will be and some of those types of things. So if it depends on the type of credit agreement you're entering into. Obviously, if you're using your credit card, well, you need to figure that out on your own. It's in your disclosure stuff. If you're taking out a fixed term loan, typically that's in the mandatory disclosures.